meant that we had more expenses than we thought we were going to have to begin with. So what that led me on was a quest to find out what kind of portfolio could I take the most money out of, essentially, which translates into what kinds of portfolios from a construction point of view have the highest safe withdrawal rates. And when I looked around and looked at kind of standard portfolios, what I saw was, I mean, a variety of things. You know, Paul Merriman's got one thing. You got a Boglehead 3 fund thing. Dale Collins has VTSAX and BND. Um, and I went and looked at what all of these people were doing. And when I say what they were doing, I mean what they were doing as individuals. Because I thought, well, maybe one of them has this solved. And the answer is none of them had it solved, because the dominant strategy for people who have been in personal finance for a long time, is simply not to spend much money. And most of their withdrawal rates are 3% or under. And if you have a withdrawal rate like that, you can hold just about anything you want. So that wasn't going to work. And so I started looking at, first of all, Bill Bengen's original research and how he had updated that. And there were a couple of characteristics that were obvious that would lead to portfolios that had higher safe withdrawal rates. One was that the equity portion was going to be somewhere between like 40 some percent and like 70 some percent. That if it was too high or if it was too low, the safe withdrawal rate went down. The other thing I got quickly out of Bengen's research was that if you have too much cash in a portfolio, and too much is more than 10%, it will reduce the safe withdrawal rate. And it doesn't matter if you put it in buckets, ladders, flower pots, or what you call it. If you have too much cash in your portfolio, it reduces the safe withdrawal rate. So going from those two things, then I started looking around at other kinds of portfolios and other research that had been done. And what I hit on was papers by Ray Dalio and Bridgewater. This comes out of the hedge fund community. And they had developed a strategy called risk parity, which was basically about maximum diversification, about having as many uncorrelated assets as you could come up with, and then arranging them in a portfolio. And what they were more interested in was balancing out volatilities, which is not really the same thing I was interested in. So basically, I combined what I learned from that with Bill Bengen's research to come up with portfolios that had higher safe withdrawal rates. And what I'm meaning by higher, 5% or more, is what we're looking at and what we're targeting for this. And so these ended up being a little bit more diversified than what you're used to. Involved taking the stocks, splitting those into growth and value portions, adding some treasury bonds, and then adding some alternatives and keeping the cash down a little bit lower. And that created portfolios that have safe withdrawal rates of 5% or more. So that's the basic story. And I've been working with this kind of portfolio for over 10 years now. So it's been working fine. I officially retired in 2020, although we had set up the portfolio about 2016 is when we really put it all together, and then have been tweaking it a little bit ever since, but it hasn't changed that much. So why don't I turn this over to Bill now for a couple comments from him, and then we can go wherever you want to go with it.
Yeah, I mean, thanks, Frank. And simple answer to my question is I found about risk parity from Frank. And what's interesting about it was, being a late starter, as you all know, and having started my journey about 10 years ago, when he started his podcast about 5 years ago, I listened to the first 50 episodes, but I wasn't at the point in my journey where I was ready for that. So I stopped listening, actually. So I turned Frank off. He wasn't bouncing around in my head for a while. But within the last year, I woke up to the fact that we were going to be FI, and I knew I wanted to do a retirement readiness checkup because I was feeling increasingly nervous about the potential for a big market drawdown right on the precipice of my being FI, which would extend my working career. And I did not want to be victim of that. And as Frank will tell you, I'm sure, you like to transition when things are at a market high. And I was in a traditional 3-fund portfolio, U.S. international and bonds, and I wasn't willing to do the 100% equity risk thing. So I was in an 80 to 85% equity portfolio over the course of about 10 years. But, and I remember very vividly, I promised for my 60th birthday, I would do a retirement readiness checkup. And that was October 27th of last year. Just prior to that, Frank, Mary, my wife and I were planning on going to South Africa together. And Frank, right before the trip, said, now, if the market tanks, you are still going to have a good time, right? So that sort of made me think about it a little bit more. And then met with an advisor that if you listen to the episode 196 of our podcast, I did a deep dive actually using AI and all the resources I could bring to bear with my network in the community to find a unicorn, which was an advisor, an independent RIA, flat fee, value-based, fiduciary, all the things that I needed for my own unique situation, who happened to use risk parity as their primary portfolio construction mechanism and was aligned with George Kinder's philosophy of life planning and living your best life, was aligned with helping me spend as much money as was safely possible in retirement, and was aligned with the fact that I was a late starter, because I think risk parity is sort of the diamond in the rough tool for late starters. I mean, we don't have the capacity necessarily, and I started at 50, of over-saving like the Bogleheads and underspending. We want to hit that enough point and then exit the building at that enough point, being able to spend as much as possible with the nest egg we're able to accumulate in 10, 15, 20 years. And so I didn't have the luxury of saving another $1 million, for example. And I can do with, say, 5 million, but in a Bogleheads portfolio, I need 6. So it's a big number difference, and that's a time saver, because you can, with a smaller nest egg, spend more safely, basically. And that was the Kool-Aid I drank, and I did a deep dive. And in the last year, I have listened to the majority of Frank's podcasts, which I recommend to everybody, not just people going down the risk parity rabbit hole, because there's a lot of philosophy, life, a lot of things in there that have nothing to do with, high leveraged risk parity portfolios for accumulation, which are also interesting, but I don't have a gambling problem. At any rate, I just found it was if portfolios were a tool to help us live our best lives, risk parity was the tool I needed to use, and at the right time. And as you may have heard, I found out we were FI. I was kind of 2 or 3 years before I was expecting it. And immediately I was like, okay, I need to transition. It's kind of like a sex change when you go from, all equities to risk parity. It feels like it. Everybody talks about it being the transition. And then there are ways to do it. Frank recommends when you hit 80% of your number, you need to start thinking about it then, if you're going to do it gradually over the course of your decumulating accumulation, so to speak. And we were at 100%, so I wanted to flip the switch pretty immediately, and did a plan. Got to know our presumed financial advisor by doing a flat fee plan, looking at, okay, what will we do? And let's run the numbers and stress test them 6 ways from Sunday using their software, Right Capital, after running our 3 years of expense numbers. And we were at 100% success rate, which is actually an overspending risk. So I'm like, we need to do this now. This happened to be last November when we had that little 3 to 4% kind of AI bubble fear momentum thing. And I knew at the time I needed to get out of the risk that we were in with regards to the equity risk we were in, because I could not tolerate it anymore. I needed to be able to exit the building completely. So I did, over 2 days, a complete shift, and we can talk about what that involved. I didn't do the slow thing. I jumped into the deep end, but I had prepared myself over the course of a year, not only financially, but mentally, emotionally, and educationally, not just looking at Frank's stuff, but at other resources on risk parity. And I might say that my current advisor, which doesn't live too far from you guys, and came down to Chicago to meet me in person before we shook hands and sealed the deal the old-fashioned way, before I handed over all the assets, which I've done in the last month. So, I mean, that's pretty much my journey to it. It's been a really fun journey. It's been very educational from both a mental, mindset, philosophical, and mathematical portfolio-based thing. But as Frank will always tell you, it's a tool that you use for your life to help you live your best balanced, life, and, spend and live and give while alive, and, not necessarily die as a hoarder with your highest net worth at the end of life, but not having, and we can talk about it too. One thing risk parity did for me, and finding out that I'm FI, immediately flipped the switch on, okay, now that my oxygen mask is on, how can I help my kids build wealth in their formative years where they have the least ability to save, but the maximum benefit from a transfer of wealth, not cash, while alive, which I think risk parity allows you to do too. It allows you to incorporate things in your budget like, okay, we're going to fund our kids' Roth IRAs or help them match and fund those, or their HSAs, which I'm a very big believer in, giving every dollar a job and making the most of it while you're alive, just like Frank. So that's kind of my journey to it. I'm very happy with it. I sleep better. I love talking about it. I think it needs to be talked about more in the community. And I really commend you guys for your really great questions. Number one, all the questions that Steve put together, which I hope we get to go through, and your interest, because you're on the cutting edge of what is the, next generation of financial independence, because the simple path to wealth is not the same as the simple path to wealth preservation. And when you reach a certain, your enough net worth, it's all about preserving it for the long run, as opposed to growing it to the moon. So anyway, Frank, do you have any comments on that?
No, I think we can go. I don't know whether we want to go to questions or how we want to do this. I could also share a screen with you and show you a comparison of portfolios if you'd like to see that. I don't know what it looks like on your end.
Yes. So my plan was to ask enough questions, and if you ask enough questions in this group, all of a sudden the conversation will start. Okay, so if you don't mind, we'll just kind of do a free form kind of thing. So if you have something that you want to ask, please just ask. Same for you guys online. If you have something, there's a little raise hand button there. We will get to you as soon as we can, as soon as we notice it. All right. Our screen's a little fuzzy in here, so we might not notice it, but I'm going to just ask the next questions. I have like 3 pages of questions that I've already sent them. So what problem does risk parity portfolio solve for someone who's starting like later in life or anything like that on this journey?
I'll take that one first, Frank, but you can. So for me, it solved the ability to exit my job, or have the power to exit my job at a lower net worth than I would have otherwise. And people as late starters don't realize this. 5% safe withdrawal rate. You're getting a 20% difference in your spend with that, or 25% difference, and that's huge. That's functionally $1 million. The risk parity is worth, in dollar terms for me, $1 million of nest egg. So it's a high value item. It allows me to exit the workforce sooner, or at least have the power to do so. It also gives me, I'm not great with the math of risk, and I'm a more emotional investor, which is one of the many reasons I needed an advisor. It gives me a sleep factor. The market can do what the market's going to do, and I have assets in all 4 quadrants of market weather that are going to operate, and I may not, grow like 100% equity portfolio or 90-10, 80-20, but I'm going to sleep better than that person in my world. It's the right choice for me, because I'm not going to. I've looked less at the market. I'm not looking at the numbers. Um, and it just gives me that psychological peace of mind. And the fact that I have an advisor as a buffer between me and the market and managing the portfolio, I don't have to, I've offloaded the math. My wife doesn't have to worry that if I can't do it, I mean, I could do it. It is DIYable. And the way Frank teaches it, it is imminently DIYable. And people think, oh, risk parity, that's intimidating, that's complex. Well, no, it's not. And Frank can tell you all about that. But as a tool for late starters, I think it should be talked about in our community a lot. Your education in finance shouldn't stop with target date funds. It shouldn't stop with a two-fund portfolio. It shouldn't stop with the Bogleheads approach. I mean, we live in the, as Frank refers to it, the golden age of a personal finance, where it's low cost access to assets that we never had before through all flavors of ETFs possible. And so we can do what Ray Dalio did in the 90s with the technology we have today that has come online in the last 10 years. And so a lot of folks in our community base their personal choices on research that's 30 or 40 years old. Well, things change, and Frank is on the cutting edge of that change. And he has the data to back it up. It's just that it's intimidating to folks because change happens slowly in medicine and finance everywhere. So Frank, do you have any other things that you can think of that might make risk parity a particular interest to late starters?
Yeah, well, I think you hit the right point because, since I've been around the FI community or FI communities since about 2008, the goal at that time was to really, retire as soon as possible. And we were talking about people in their 30s and 40s. But obviously, if you're going to retire as soon as possible, it's the same problem you're having if you're a late starter. You just have less time to accumulate money. And if you have less time to accumulate, then anything you can do that would allow you to spend more on the other end reduces your time of accumulation, essentially. So you get to retire sooner. In terms of the sleep well at night factor, if you compare these kinds of portfolios to kind of a standard stock and bond portfolio that you might have held, like a 60-40 or a 3-fund or something like that, these kind of portfolios have about half of the maximum drawdown. So instead of having like a 40% drawdown in 2008, it was more like 20%. And then the length of the drawdown is substantially less. The biggest problems that traditional portfolios have in drawdown is that they can be underwater for up to 13 years. And if you go through a period like the early 2000s or the 1970s, a standard stock bond portfolio could be underwater for 13 years. With one of these kinds of portfolios, the max number of years you're going to be drawing down is like 3 or 4. So that also solves any short-term sequence of return risk that I know people get obsessed about and want to hold piles of cash to deal with. This is a way better solution than that, because the problem with a pile of cash is it doesn't solve your real problem, which is the danger of having a bad decade. And that's really what this kind of portfolio solves in terms of, I know that this portfolio, if we have a bad sequence, it's going to hold up a lot better than some other portfolio that I might have chosen. So in terms of sleeping well at night, those are, I think, the attractive metrics to be looking at.
Awesome, thank you. And this question might lead to your video, Frank. So how does risk parity differ from the traditional 60-40 stock bond portfolios?
Okay. So there are, I'll give you a reference here so you have it. When I went on Paula Pant's podcast, Afford Anything, it's episode number 618, but she created a blueprint or cheat sheet that has the information I'm about to give you. So if you want to go find that, write that down so you can go look at it later and pull it down. So basically, what we're doing is we are taking the stock portion of a 60-40 portfolio and diversifying it a little more. And the way we are diversifying the stock portion of the portfolio is to explicitly divide it into a growth side and a value side. Now, the easiest way to do that is if you started with VTSAX or VTI, you could use that as your large cap growth fund, or you could actually get an explicit large cap growth fund. And then you can pair that with a small cap value fund. And you can have a two fund stock portion of your portfolio if you wanted it to be that simple. Now you can add as many other funds as you want. You can add international funds. You can do whatever you want. But the principle is to divide your stock portion of your portfolio into explicitly growth tilted stocks and explicitly value tilted stocks. And other than that, there's kind of a lot of leeway as to how you exactly do that. But you can do it with as few as two funds or as many as 10 if you want to be a Paul Merriman follower, because that is essentially what he does in his portfolios. If you this was kind of stolen from Paul Merriman, believe it or not, the stock portion of this. The reason it works really well is because when you run into periods like 2022 or the early 2000s, and you have a bubble in growth stocks and it crashes, frequently the value stocks in your portfolio will not crash, and they might even go up. And so that saves you. That is what saves you from these problems with high valuations and bubbles and things like that, because that's going to occur on the growth side. It's not going to occur on the value side. Okay, then for the rest of the portfolio, what you are really looking at is what are the assets that I can hold, since my stocks are the driver of this. What are the other assets I can hold that are the most diversified from stocks? And when you look at bonds, the most diversified bonds you can hold that are the most diversified from stocks are U.S. Treasury bonds. That they just happen to be that. So you want to just hold those. You don't want to hold corporate bonds. And the reason you want to do this is because in this kind of portfolio, these bonds are only doing one thing. They only have one job, and their job is to hold up and go up in value during a recession. So whether it's a 2020, a 2008, the early 2000s, all of the recessions back to the 1950s, and I have this data, all of the recessions, in all the recessions back to the 1950s, when the stocks went down, U.S. Treasury bonds went up in value. And then you want to make those on the longer, intermediate and longer end, because the short ones don't do anything. They act like cash. It's the 10 years and the 30 years that will go up in value. Now, fortunately, as Bill said, we have all the ETFs we can just do this with. In fact, Vanguard has nice ETFs, intermediate treasury bond fund, VGIT, and a long-term treasury bond fund, VGLT. So you just take them right off the shelf. There's no running around worrying about trying to figure out where to get these things. They're all right there for you. After that, then, the other thing, then the question is, well, what else besides stocks and bonds? And the main asset that has shown diversification from both stocks and bonds, and that's what you're looking for. What assets are diversified from both stocks and bonds? The easiest grab there is gold. Gold has been uncorrelated to both stocks and bonds since forever. And when you look back, as long as you've been able to own it in the United States, if you have added 10 to 15% in gold to a portfolio, it will increase the safe withdrawal rate usually by between 0.3 and 0.5%. This research was actually done by Big Earn of Early Retirement Now. If you go to his website, look at safe withdrawal rate series number 34, and he analyzed portfolios going back over 100 years to see whether gold had any effect on the safe withdrawal rate. And it does, and it's consistent. And so that is one of the things you add. Now you could, then there's, what else could you add? You could just use those three things and be done actually. And you'd have some semblance of a portfolio there. The other things that you might add as additional diversifiers are one, an asset called managed futures, which didn't used to be available, but now is available in ETF form in a cheap enough form. That is a trend following strategy that is also diversified from both stocks and bonds and from gold. The other things that you could use in this kind of portfolio might be like a REIT fund or a utilities fund, some little part of the stock market that tends to move differently from the stock market. And so you can construct portfolios that have things like REITs or utilities in them. Now, in theory, you could use all kinds of other things. And if you look at what Ray Dalio and Bridgewater do, they have like 15 different asset classes, and it gets really complicated. You don't need to get that complicated for what we're trying to do here. You need 4 or 5 different things, and that's sufficient. And then you just add to that how much cash you want to have in your portfolio. Just keep it under 10%. So you can change the sort of the allocations to make your portfolio more aggressive or less aggressive. So you can make a portfolio like this that has 40% in stocks in it, or you can make one that has like 70% in stocks in it. What you'll find is the ones with more stocks in them tend to have higher returns over long periods of time, but have higher volatility, and vice versa. So it's kind of how well you want to sleep at night with respect to that. As it turns out, whether you have one that has like 40-some% stocks in it or 70% stocks in it, they're going to have similar safe withdrawal rates. That's not going to change that much. So the percentages end up being between about 40-some% and 70% in stocks, between 15 and 30% in intermediate and long-term treasury bonds, and then between 10 and 25% in alternative assets. And then 10% or less in cash. And if you fit those basic guidelines, you're going to have a portfolio that has a higher safe withdrawal rate. It'll be like 5% over the past 100 years, or 6% since 1970 is the usual metrics that when you run these things through Monte Carlos or through historical analysis.
That's great. Did you want to share that video on the?
Well, I was going to just share a little screenshot of a portfolio analysis comparing one of these portfolios to a couple other portfolios, if that makes sense.
Yeah.
Wait, Frank, what were the percentages again? The 30% treasury bonds, what was the first one?
The stocks between 40 and 70%. 40 some and 70 some, really. It's not that precise. That is, and divide that into growth and value.
Question, Frank. I know, I know we talked about using, if you have Vanguard, like ABUV for a small cap value. Does it have to be international? Because there's a lot of buzz about, international stocks. Do we have to use that, or is ABUV okay for a small cap?
If you, I mean, if you just want to have 2 domestic funds, you can do it with that. You can do it with VTI or VUG, which is VTI's total market, or VOO, S&P 500, or VUG, which is large cap growth, something like that. And you pair that with a small cap value fund, AVUV or VIOV. You could just use those 2 funds as your stock portion of this portfolio. But I always run into people, well, what about international stuff? Well, if you want international stuff, then go over and get a large cap growth kind of thing in international. A nice one is IDMO, which is a label as a momentum fund, but it's a large cap growth fund. A nice small cap value fund on the international side is AVDV. And again, all of these things came into existence within the past 10 years, a lot of these kinds of specialized funds. What I would not recommend is do not use VXUS or the Total International Fund. because it's too large cap growthy and moribund banks in it and things like that. It just doesn't return as well as these other funds I'm talking about. And I mean by last year, the funds I'm talking about were up over 40% and VXUS was up 30. So it's a significant difference.
Yeah, I can speak to that a little bit because I do believe in international as a diversifier. It's more sector diversification than it is factor diversification. And I wanted to speak to Frank's growth value thing. We're not using value as a performance thing. We're using it as a diversifier thing. Paul Merriman talks about the performance of value and accumulation a lot, but in risk parity, it's much more of a diversification focus, not a performance focus. And there's actually a pretty simple mathematical concept here called Shannon's demon, where if you invest in two separate assets and then at opposite ends of the spectrum, so to speak, and rebalance them according to bands or annually, you will end up with a rebalancing bonus. And the performance of those two assets, two is better than one, so to speak, if I may say it that way. And there's a mathematician who's very famous, but we don't talk about. And there's a great article on this on Portfolio Charts written by Tyler, who runs that website. If you understand Shannon's demon, you understand why you split into growth and value. And we're taught to be scared of value. And frankly, I was scared of value. But once I understood the purpose of it in this portfolio, it was easy to embrace. And I also, speaking to the international thing, I did, and we can talk about our individual portfolios, but I chose to design mine with my advisor with a focus on smaller portions of international growth and international value. And I did use IDMO, I did use AVDV, and then I already had sort of a large cap growth blendy thing going on. I didn't want to take the tax hits to push it into VUG, but, and then I used UV for the international, for the U.S. value. So mine is like along prime numbers theory. I'm 17, 17, 7, 7. I'm Optimus Prime. He may be golden ratio, but I'm Optimus Prime. And I've been on a horse race with him. I've been in a horse race with Frank, and I'm winning the horse race lately because of internationals. But I added my own spice, and I've always believed in international. I've stuck with it, and it made sense. And if you look at those four equity asset classes, and this is very recency biased, but in the last year, three of them have outperformed, the typical VOO, VTI, or VUG dramatically. And so, this is science. It's math. It's not, crystal balls, as Frank would say. And once you understand the foundation of this, it's easy to embrace these asset classes that might make a typical boglehead nervous, because Paul Merriman and his tables kind of overwhelmed the bogleheads and his small cap value speech. But what he's talking about is actually different than what Frank's talking about with regards to the utility of value in a risk parity portfolio. We should probably take a step back and talk about why. Because the golden ratio is a numerical symbol for balance, 1.618, something like that. It's in the Nautilus shell. It's all over nature, and honestly, it's really interesting to see that Frank's golden ratio outperforms the majority of risk parity portfolios, and it's in harmony with nature. And then when we talk about nature, we're talking about weather. And what I didn't understand before this was, there's four predominant economic weathers in which we operate. We've only been living in one of the four quadrants for like 15 years. And the four quadrants have to do with a growth spectrum, growth and recession, and then on the vertical axis, inflation, deflation. And we've been living in a low inflation, higher growth environment in one of the four major economic weather quadrants for 15 years. So there's a lot of recency bias here. There's a lot of danger in being an all equity portfolio right now. There's a lot of danger in being probably a boglehead right now, because we've been there for a long time. And as we will say, history may not repeat, but it rhymes. And the next recession is always coming. And I didn't understand, and we should talk about it, long-term treasury is like, I'm like, that's too risky or too volatile. I'm like, well, actually, you want that here. And Frank can talk about why you want that. And then gold and managed futures, you want to have something operating in each quadrant of weather, whether it be high inflation, high growth, high inflation, low growth, or recession, high inflation, recession, low growth. And we forget that there's many environments that the economy operates in, and I'd rather have a portfolio that has something working for me in every environment. Is that about right, Frank? And you please correct me if I'm wrong, and because I'm the hack here, you're the expert.
Yeah, no, you said everything right. That the and I think that four quadrant model is something that was developed by Ray Dalio and Bridgewater back in the 1990s. It's used by essentially everybody, every sophisticated investor who's trying to read tea leaves or figure out what to invest in is always looking at those things. But the reason that's important is that tells you where diversification comes from, that whether assets are correlated or uncorrelated, it's not a random thing. If you have a recession, stocks almost are certainly going to go down in value. Treasury bonds are almost certainly to go up in value. And that's where you get the negative correlation from. If you're not in that quadrant, if you're in a quadrant like 2022, where you have high inflation and lower growth, you can have both stocks and bonds going down in that environment. Although value stocks did okay with respect to that. But so all of these things are I think there's a very big misunderstanding that I hear people often say. It's like, well, the last 40 years, stocks and bonds were uncorrelated, and now they're correlated, and that's the way it's going to be for the next 40 years. That makes no sense whatsoever. These things are not random. They are not falling from the sky. They don't just change on a whim. They are dictated by whatever macroeconomic weather or environment we're living in. And the purpose of a portfolio like this is to hold something that is going to at least survive or do okay in all of the environments. And so you're diversified if at least one of your assets is not performing well that year. That should, if you have a diversified portfolio, that should be occurring. You should always have something that's doing badly, because if not, the chances are your portfolio is not very well diversified. I will say the other thing is I do. Bill likes the formulas more than I do. I do want to get away from the idea that there's a particular formula that you need to apply to this. This is not. Oh, we need the 60-40 portfolio. Oh, we need to have this much in VTI and this much in VXUS and this much in BND, and that's the portfolio. That is not how this works. We're talking about ranges of possibilities to get a particular outcome, in this case, a higher safe withdrawal rate. But within that, there's a whole lot of flexibility in how you actually construct your portfolio. And I think if you get out of the mindset of, well, it needs to be exactly this, or it's not the right portfolio, that's not a good way to think about portfolio construction. You want to think about it more holistically, as in ranges.
Great. Well, you guys have brought up a couple good questions here. So I'm going to start with, what simple risk parity portfolio works well for somebody who's a beginner investor, right? So we don't fully understand the risk parity yet. We understand that the volatility of the markets, especially like in 2008, 2022, today, with our, going to war, we don't know how that's going to impact the future. So what is a simple risk parity portfolio that works well for somebody who's just starting out?
Okay, well, I assume you're just starting out as a retirement portfolio. Because you would not use this for accumulation. You should recognize that this is not for accumulation. That you really want to be holding many more stocks, 90 or 100% in stocks when you're accumulating, which is nice, because what people have started doing, and I didn't realize this when I started doing this until I got with Mindy Jensen and the Bigger Pockets Money podcast, and we sat down and created a sample risk parity portfolio for her to have and to follow and to use. And you can do this now if you go to a place like Fidelity, because you can buy ETFs for $1. So you can take like $1,000 and put it into account and create a little test portfolio. But let me show you a couple of the most popular ones. I'll just bring them up if I can share this thing. That's the easiest thing to do, I think.
Yeah, while Frank's bringing it up, that was a genius move he did with Mindy. It affected me immediately. And the retirement portfolio I created with my advisor, I have $10,000 in a Fidelity account distributed and allocated according to my portfolio, and I am drawing it down because I want to know what my advisor is doing. I just didn't hand everything off. I have to know how the engine's running. And so every month I'm taking distributions from it, and it's working great. The other way you can do this, which is interesting, and I think Frank will talk about this on one of his shows coming up, is if you're charitably inclined and you may have a DAFI, and we did an episode on this, donor advised fund, you can put money into your giving account, and we have our donor advised fund, and you can create now at DAFI a risk parity portfolio. You can customize your portfolio for charitable giving to generate, and we give away 5 or 6% of our donor advised fund every year. And so it's a drawdown portfolio for charity. It's a generational giving engine. And so you can play with this if you want to in a giving way, where it's helping people. It's not, you're not living off of it. So there's a couple of ways you can experiment with this. And I'm happy to help anybody individually or otherwise if they want to do it. But yeah, just like anything, you have to experiment. So I do recommend, as you're heading towards retirement, create one of these things that along the lines of what you think is your needs and risk tolerance, and then draw down from it, because it's a muscle you have to build before you do it.
Okay. Can you hear me?
Yes.
Can you see this screen that I shared?
Yes.
Okay. So this is the site testfold.io. This is a relatively new site that was put together, and this is a wonderful site that everybody should be using these days, because you can backtest and do all kinds of things here, and it's free. So this is what Portfolio Visualizer used to be like before they made everybody pay for everything. But this one has even more things on it. So they've kindly put 2 sample risk parity portfolios as presets in here, and they are the Golden Butterfly and the Golden Ratio. And so I'm adding these. So we have 5 portfolios now here that are that we're going to be doing a little test with, back test with. So I would say the simplest one would be this Golden Butterfly. This is a conservative portfolio. So what these represent, and these tickers are designed to capture more data. That the SIM means a simulated when they run out of backtest data for the ticker itself. So in a Golden Butterfly portfolio, you have 20% in a total stock market fund, a VTI or a VTSAX. You have 20% in a small cap value fund. Here they're using VBR. Other ones that you probably want to use would be VIOV or AVUV. So you could, type in one of those. I'm going to leave this how it's set up because it captures the most data. This next thing, SHY, is a short-term bond fund. It's a 1 to 3 year treasury bond fund. That makes this portfolio very conservative, as it turns out. And then you have TLT or VGLT now. That's long-term treasury bonds. And then you have gold. And so there's just 20% in each one of these. So you end up with, and the way Tyler at Portfolio Charts is the one who invented this back in like 2015. He was one of my original OG people back on the early retirement extreme boards back in 2011. So this one is 40% in stocks divided into a total stock market fund and a small cap value fund, 40% in treasury bonds divided into a long-term treasury bond fund and a short-term treasury bond fund, and the remaining 20% in gold. Now I'll go up and show you this golden ratio portfolio. And this also is a variation on a theme. So what this one has in it, it has a number, you'll see a number of similar assets. The first one, that is actually a large cap growth fund. So instead of having a total stock market fund, there's a large cap growth fund. Those two things actually overlap a lot. They contain a lot. Right now, they contain all of the Mag 7s and all of that sort of stuff. This a large cap growth fund is going to be more concentrated in those growthy tech kind of stocks. Some people would also use like the NASDAQ QQQ in that position if you want to be more aggressive with it. This is a small cap value fund. So this is, again, this one has 42% in stocks in it. It's divided into growth and value. This one has 26% in treasury bonds. That's the TLT, or that could be VGLT. It's got 16% in gold. The GLDM or IAUM are the cheapest funds for that now. All of these funds keep getting cheaper. And then this is a managed futures fund. This nomenclature is a little bit confusing because it's basically taking one fund, DBMF, which is probably the best choice. It's the closest thing to an index fund in that category. And then when that runs out of data, it picks up KMLM. This is just a feature that Testfolio has to allow you to essentially say, I want to back test, and I know this asset or this fund only goes back so far. And when you run out of data, pick up this other fund. And then this one's also got 6% in cash in it. Now, a lot of times what we do with this, and what I actually do with this, I don't keep 6% in cash because that's unnecessarily large amount of cash. But if you really wanted it, you could have it. What I would use this 6% for is making that international stocks. And so I have what Bill has, which is a large cap growth fund, IDMO, and small cap value fund, AVDV, has that 6%. And so this ends up being like 48% in stocks, and then the other three assets. Now, when I did one with Mindy, we did something similar to this golden ratio portfolio. And you can find this on YouTube. I suggest you just, because then you can see it and you can see us building it. So she decided she wanted, I think she's got VUG as a large cap growth fund, AVUV as a small cap value fund. She decided she wanted to divide the treasury bonds into an intermediate fund and a long-term fund. So she's got an intermediate treasury bond fund, VGIT, for 13% and 13% in VGLT. She's got 16% in gold. She's got 10% in DBMF, the managed futures fund. And then she's taken her 6% and divided that, made that international stocks and divided into two things. And so that's the other ways to vary this. You could add more stocks. You could make this up to 50 or 60% in stocks. You can change these around a little bit. It's not going to change the overall safe withdrawal rates that much. So we'll just run this back test here so you can see what these look like. And then if we go down, you get the results. And you can see these nominal ending values. This back test goes back to 1993. You can make it go back further if you do more things to it. Let me see if I have a withdrawal rate going on this or not. Okay, yeah, this actually is taking a 4% withdrawal rate. This cash flow, I've set it up that way. And so this is what would be left after taking 4% out of it since 1993. And this is adjusted for inflation over time. And so you can see where these things end up. That the golden ratio by far is the best performer. The golden butterfly performs just as well, what you're attractive about this is how less the drawdowns were of it, how low the volatility is. These statistics over here are important because they tell you how severe the ride was. And then this is being compared with a 60-40, a three fund portfolio. 5-year cash bucket is what I hear people wanting to do now. They take their VTSAX and chill portfolio and decide, well, I'm just going to add 5 years of cash and call that a cash buffer, and that'll help me. It's not going to help you that much. It'll help you some, but so you see how this plays out. Now, 1993 actually was not a bad year to retire in. Let's change the year here to a bad year to retire in. The worst in most of your lifetimes is starting in the year 2000. So if you retired, whoops, not 1010, it should be 0101 2000. And we'll run this back test again. And now we can go down here and see what that would have been like. You see the golden butterfly and the golden ratio portfolios survived, did okay. They have more than what they started with. These other standard portfolios are doing badly. And they have less money than they started with, significantly less money, particularly that 5-year cash bucket portfolio. If you're thinking that's going to solve your problems, you may end up with a whole lot less money, even on a 4% withdrawal, because you could see it is down to about $4,000 after 30 years of this. Actually, it's down to 8. It's down to, depends on whether you're doing it real returns or nominal returns. But you can see why you want to hold this in worst case scenarios. And to make it even worse, and how you know what you care about is that safe withdrawal rate. So let's up that we'll up that withdrawal rate to 5%. We'll go over here and put this cash flow to minus 500. And then we'll do a back test. And guess what? You ran out of money with your buffer strategy. You're about to run out of money with your 3-fund strategy or your 60-40 portfolio. If you held one of these risk parity style portfolios, you're fine. And this is a worst case scenario. This is the kind of test that you should be running on any plan that you tend to want to take into retirement. It is not sufficient to go to Bolden and put in percentages and come up with something. You also, if you're going to use a return and a standard deviation, you also need to do the historical back tests. In particular, this one starting at the beginning of 2000. You also need to do the one that starts in 1968 or as close to it, because those are the 2 worst start dates. That's your real stress test, because that will tell you exactly, if you would have done that, what would have happened. And that's kind of, to me, that's kind of the minimum, that you at least need to have survived historical periods. But you can see here as to why you want it. If you started with $10,000 back in 2000, took out 5% a year, with the golden ratio and the golden butterfly, you have, instead of 10,000, you have 25 or 28,000. With any of these other portfolios, you ran out of money or are about to run out of money. And that's why you want to use a portfolio like this if you want a higher safe withdrawal rate. Now, if I change the safe withdrawal rate to 3%, then all these portfolios survive. But that's a big difference there. Now.
Awesome. And just as a reminder to everybody on the phone and in the room here, I am recording this, so you'll have a download. There's some people in the room running to my computer to get screenshots and stuff. So know that you'll have this at home. I just got to figure out how to share it. So
okay.
All right.
Well, write down this website, because except for that 5-year cash bucket portfolio, all of these are presets on this website.
Can you share that website name again, please?
It's Testfolio, testfol.io.
Hold.io.
TESTFOL.io.
Thank you.
Yeah. Yeah, you'll really enjoy this website and they keep adding things all the time. They now have a pay part of it and a free part of it. It's got more things than you could ever imagine or want to use, things like efficient frontiers, but you can also use this to just look up assets, any fund that you want. You can just look it up and see how it's performed, or put in 5 or 10 of them at a time. But it has this preset function, and you can bring up different kinds of portfolios or just create your own. And you can test up to 5 portfolios at a time with this. But it's a very useful tool, and I would say it's a mandatory tool. If you are really going to DIY this stuff yourself, you need to be using tools like this and actually doing tests, and not just hoping and thinking that something's going to work when you haven't really stress tested it.
So, Frank, this is great, and obviously the portfolio performed really, really well. But it seems like a lot of work, right? So how often are you rebalancing this portfolio?
Once a year.
Once a year, that's it. Okay.
Yeah, you can rebalance this once a year. If you want to do the simplest way to draw off a retirement portfolio is if you do have part of it that's cash. Say you got a version of the golden ratio and you have maybe 5% cash in it or 4% cash in it, or you have that golden butterfly portfolio with a short-term bond fund, which is essentially like cash. You could just withdraw from that the whole year round, do nothing else with the portfolio, and then once a year look at the whole thing, rebalance it, refill your cash bucket or whatever there, and go for the next year. So no, this does not take a lot of time, and it's really not that complex. It's unfamiliar, and don't confuse unfamiliarity with difficult, hard, complex. What most people are doing in the rest of their lives with tracking credit card points and tax strategies, HSAs, all that other stuff. That's more complicated than this is.
What Frank just showed you is really profound. And I can tell you from real world experience, our advisor uses Testfolio. Our advisor uses Portfolio Visualizer. Our advisor actually uses Monarch to track, and all of our data went up into Monarch. He uploaded it into his spreadsheets. We ran portfolio back tests on things that we thought we wanted to do. It was a very collaborative process. I could even show you Optimus Prime versus the Golden Ratio back to 1994. I've got that here too, if you wanted to see it, where it adds international. It runs pretty much the same, like Frank said, over the course of time. And then it's really important to back test as far as you can, as many years. I mean, 25 to 40 years is probably a minimum. A lot of people are looking at like, oh yeah, the last, recency bias of the last 3, 5, 10, 15 years. Well, that's not going to last. And he just showed you dramatically what it can look like and what the current financial independence movement has really not experienced. So, the simple path to wealth is very different from the simple path to wealth preservation. And it isn't just a minor tweak. It's still easy, as you've seen with 5 or 6 funds. I have a few more. But this is knowledge I think that's critical to get out there. It's very important to get out there and talk about, because financial technology has evolved. Financial wisdom doesn't need to stop with 30-year-old research or a simple 2 or 3 fund portfolio that may not operate in the weather we are about to have coming forward. So it really hit me. I mean, it's like reading the shockingly simple math of early retirement. To me, it's the same thing. When you run into this stuff, it's like, oh my God, there's a better, safer, less volatile way to live in retirement where I want to focus on life and not on money.
Right.
Yeah, I do also think that in order to get familiar with something like this, that having a little test portfolio, I think this is going to be the way people do financial independence going forward, is that you should take whatever you think you're going to retire with. Create some little sample test portfolio on Fidelity or somewhere like that. Put $1,000 in it, 5,000, 10,000, some little amount of money. And the reason you can do this now is we have no fee trading. You can buy as little as $1 worth of an ETF. So there's no reason not to do this. And if you do this, if you do a little practice, it's basically taking a little portfolio with training wheels on it and giving it a test drive until you feel comfortable with it. But this is going to make sense regardless of what you think your retirement portfolio is going to look like. There's no reason not to test drive it now, and you can do that you could not do this before 2020 because of transaction costs and other costs. This is
a question here that I want to get to. So
yeah,
go ahead.
Hey, Frank, my name's Dominic. I'm your first donor. I told you to set up your Patreon. So,
thank you, Dominic. and Mary thanks you too right now because we're taking the money to go to her charity the next couple months here.
So you've been so beneficial to me and my family. Quick question in terms of asset location. My portfolio is about 40% taxable, 60%, 401ks and IRAs. And as you know, your VTIs should go into your taxable accounts. But then now I'm looking to take money out of my 401ks. Should I have like a withdrawal should I put like all the assets into risk parity type portfolio for my 401ks? And then
Frank, can I take that one, Frank?
Yeah, sure.
Yeah, people.
When you screw it up, I'll fix you.
Yeah, you always do. But this is a fascinating thing, really, because we accumulate in 2 or 3 funds, and then how do I transition and where do I put things? Fundamentally, I put all my defensive assets, long-term treasuries, managed futures, gold, in pre-retirement, in 401ks, IRAs. So it does a couple of things. You have all your ordinary income generators in there with interest and whatnot, and then you're not going to grow your IRAs or your 401ks as quickly, which will mitigate RMDs later. And you put all your growth assets, your equities, in your taxable brokerage, your Roth, your HSA. So essentially, I have all U.S. Equity funds, my large cap growth and small cap value in taxable. That's what's there, and a little bit of cash. And then in Roth and HSA, I have some of my international and value going on in there. But it ends up looking a lot different. And what the thing that I learned that helps me understand why this is done this way and looking at your portfolio in toto is there's something called an asset swap, where you say, oh, how do I sell gold when it's up, but it's not in the right place? Well, maybe Frank can walk you through what an asset swap is so that no matter where the asset is, and there are better locations for some than others, you can sell that asset in, say, a taxable account, even though it doesn't live there.
How do you rebalance them?
What was the question?
How do you rebalance after you've taken out, say, 5%, right? So let's say, your VTI and your taxable is not doing well that year. You don't want to sell it, right? So you're taking money out of your 401k, but then, how do you rebalance, between the taxable and non-taxable assets? Because like Bill says, you put in your stocks or higher growth stuff in your taxable.
Yeah, well, you'll end up with parts of assets in all the accounts. So the most tax efficient way to rebalance is to do most of it in your retirement accounts. So you may end up selling some bonds in your retirement account and buying VTI in your retirement account. You would certainly not take money out of that and put it over you would not prioritize asset location over just good tax management. So what Bill is talking about is that's how you set it up. But over time, you are correct that when different things move differently at different times, you may end up with some bonds in your taxable account. You may end up with stocks in your retirement IRAs. That's fine, as long as the total adds up to what you want it to be, and you are not incurring taxes just to get, you would never want to pay extra taxes just so you can move VTI out of the retirement account into the brokerage account. What you would end up doing, say your stocks go down 1 year and your bonds are up, it's a recession. So you sell some bonds in your IRA and you buy some stocks in your IRA. The next year, the stocks go back up. And so now you're heavy on stocks. Well, you can just sell the stocks that you just bought last year in your IRA and buy the bonds back or something like that. In general, you try to do most of your rebalancing transactions in retirement accounts, either Roth or traditional, to avoid creating unnecessary transactions in your taxable accounts. So yes, it does look a little messy over time, over years, but it does work. So for instance, in my case, I've been like selling gold for several years and have been selling all the gold out of our retirement assets and living on that. But I can explain how we did an asset swap with that to essentially get the money out of the retirement account without actually taking the money out of the retirement account.
So I think that would be a good road to go down, because there are several questions, I think, on doing those asset swaps. And I know that's something Bill is passionate about too.
Yeah. So there is a video on YouTube that you should look up. One of my listeners who runs a site called Risk Parity Chronicles has created some explainer videos of various things. And one of them is about asset swaps. So if you go to YouTube and type in Risk Parity Chronicles and asset swaps, you will find this video. It's like a 10-minute video. So the way this works is this, and this is what we've actually been doing for the past few years. So we had our gold mostly in retirement accounts, and have been selling it out of there to essentially live on it. But we didn't want to actually take the money out of the retirement account and incur the taxes. So this is how you do the swap. You sell the gold in your retirement account. You need to sell something outside to use. So I would look at my stocks and I'll find something that is going to be the most tax efficient to sell. So I would sell some stocks in the taxable account. Now, I am going to buy back the same amount of stocks in the retirement account. So there's two sets of transactions going on here. In the retirement account, we sold gold and bought, say, VTI. In the taxable account, we sold VTI, the same amount, and then used that money to live on. That is the most tax efficient way of doing this, because you're not taking money out of the IRA, so you're not getting taxed on that. You're incurring long-term capital gains taxes on the money that on the sale that you did in your taxable account, which is likely to be 0 or 15%. But that's an example of an asset swap, that you do a multiple transaction in a retirement account or somewhere else, and then you're effectively, the swap is I'm selling the VTI in my retirement account, in my taxable account, but I'm buying it back the same amount. So I end up with the same amount of VTI over what it looks like when you add up all of the numbers is that it looks like I have the same amount of VTI I started with, and my gold is less than it used to be. But I didn't take any money out of the retirement account. That's an asset swap.
That's very helpful. Thank you.
Yeah.
So
and that is illustrated on that video too. And you can do that with any asset. This was just the example.
So John had a question that isn't gold a nightmare and taxable, but it sounds like you're holding all your gold in a retirement, right?
Yeah,
So
you would prefer. It's not a nightmare. It's just there are two things. Gold is taxed at your current. It's taxed at your current ordinary income rate, but it's capped at 28%. So if your ordinary income rate is 15, it'll be 15. If it's 22, it'll be 22. It's whatever it is. It's like getting interest essentially on a CD or a savings account. That's what happens in a taxable account. I have found out from my tax person that you are allowed to tax loss harvest the gains in gold against the losses in something else that's not gold. So you can tax loss harvest away that potentially that gain. So the rules for gold are annoying, but it doesn't. As it turns out, it is sort of not as good an asset to hold as a stock fund in a retirement account. I mean, I'm sorry, in a taxable account, but it's certainly a better thing to hold in a taxable account than a bond would be, because it doesn't pay any income every year. And that's the problem with bonds, is they keep throwing off ordinary income every year that's taxable in that year unless it's in a retirement account. So that's why you'd prefer to keep the gold in the retirement accounts. It's not that big a deal if you have some in your taxable as well.
okay, so I'm going to get into a little bit more of practical implementation questions. So what ETFs make it easy for somebody to build a simple risk parity portfolio?
Okay, so I mean, we can go down the list of different ETFs. A lot of these are Vanguard funds. So in the stock category, if you already have VTI or VOO, you can use that as your large cap growth, particularly if it's already in a taxable account. I wouldn't be selling that to incur taxes just to buy something like VUG. There would be three large cap growth funds I might use. One would be VUG. One would be IWY, which is an iShares large cap growth fund. The Schwab large cap growth fund is SCHG. Any of those could be used as a large cap growth fund, and they're all holding the same stuff. It's just a matter of how many holdings they have and how concentrated they are. So that's your large cap growth or total market kind of thing. If you're looking at the small cap value side of things explicitly, the preferred fund to use now is AVUV. I should also mention, if you go to Paul Merriman's site, he has something called Best in Class ETFs. And a lot of these things are on his site or right off his site there. So keep that in the back of your mind or write that down. But for a small cap value fund, AVUV is a good fund. There is a DFA fund that I'm forgetting what the ticker symbol is right now. The standard ones from Vanguard actually has two. One of them is VIOV, which is based on the S&P 600. And the other one is VBR, which is based on the older CRSP index. So if you didn't use AVUV and you wanted like a Vanguard index kind of fund, I would use one of those. I probably wouldn't use anything else for that. There's a Russell version of it that's not as good. I did just do a podcast with Mindy and Scott last month about small cap value funds. And so you might just want to go listen to that, because that talks about there's more variation on the small cap value side than on the large cap side, because they are based on different indexes. And so they have actually different kind of formulations, even though they're all investing in the same kinds of things. Now,
One second, Frank, just to
yeah.
jump in for a second. People look at VBR as an ETF that's quote unquote small cap, but it has a lot of growth in it. And as Frank always says, you want to definitely lean and stay in the value category, because growth is highly volatile and doesn't really give you diversification. So VBR would not be a fund necessarily I would recommend. I don't think Frank would either. I use AVUV, the Avantis fund. It has what, a profitability quality factor overlay that gets rid of some of the losers in the value category. So it is kind of a little bit actively managed, I guess you could say. But
it's got a filter. I would say it's got a filter on it. It's not people sitting around a table picking stocks. It's
an algorithm.
Yes. This was the subject of that podcast I just did with Mindy and Scott.
Well, and then its expense ratio ends up being about 0.3, 0.35, something like that.
It's 0.2 or 0.25. I can't remember which.
Okay.
But
I thought you said 0.25 on the episode with Mindy and Scott.
Yeah,
where these questions are coming from. So
yeah. I mean, it does perform like 2% better than the standard index funds, though.
Yeah.
Now those are not the only things you could hold, because people often have other things that they want to put into this portfolio. So some people want to use a fund like SCHD, which is a Schwab high dividend fund. That is actually a large cap value fund. And you can find out what these things are at Morningstar. If you go to Morningstar and put in any fund and then go to the portfolio tab, there's a little thing that looks like a tic-tac-toe board. And it basically tells you where on the spectrum of large cap, small cap, growth, value does this thing lie. And so you can take any fund and put it in there. And because sometimes I'll find people that they already have a whole bunch of funds. They don't want to sell them. And I said, well, just go categorize them and see what you already have, because maybe these can be your value funds and those can be your growth funds, and you don't need to have a whole bunch of transactions. Because again, this is not a formula that we need to have this fund in this percentage or it's not going to work. That's not how this works. All we're doing here is making a reasonable choice between growth and value, and large and small. So I would say the other kind of general rules for this part of the portfolio are: avoid things that are small cap growth, because they tend to be high volatile and not very good quality. So that's why you don't really want a small cap blend fund like VB. VB has all of the small caps in it, including a lot of small cap growth. It's different from VBR. It's worse than VBR. But that's why you want to avoid small cap growth. And then you need to recognize that if you hold things that are in the large cap value category, they are both less volatile, but they also have lower returns over time. Those are your Procter & Gamble kind of stocks, your ExxonMobil kind of stocks. It is fine to have some of those in your portfolio, particularly if you want a more conservative portfolio. But just recognize that if you are looking for kind of max performance, or performance that's at least as good as the total market, you would focus more on small cap value and large cap growth, because those two work well together. And I would be very confident that a portfolio composed of those two things is going to perform at least as well as the total stock market.
One thing I would mention there, Frank, is I had exactly that issue in transition, because I had not accumulated small cap value. I had essentially large cap blend on my taxable side. And I did have to take a little bit of a tax hit in order to get enough small cap value into, you could accumulate into that position, or in my case, because I didn't have the time to accumulate into that position, I did have to sell some of my position in large cap blend. And I have VOO, VTI, even some VUG. So all those things fall into that asset class category of large cap growth or blend. You don't have to be perfect. And yes, like Frank said, you don't want to sell things just to make it perfect and make it all VUG. I would add, though, for your kids, on the accumulation side of this, if you want to help them and you want to lead them towards risk parity, for my kids, they are accumulating in VUG and AVUV, 50-50 in all their accounts. And what that does is in the taxable side, you're going to have your 50-50 split right away in large cap growth and small cap value. And you won't have to incur any sales there. You can do all the things you want to do with Roth and pre-tax in diversifying into your other asset classes. So how you accumulate for the next generation, I think, Frank, correct me if I'm wrong, can make it easier to make the transition because you don't have to do any work on the taxable side.
Yeah, if you're starting from scratch, and that two fund portfolio does well outperform VTSAX or most other things over the past 100 years. It's like a 2% annualized difference. Part of it's out of a rebalancing bonus, but part of it's just out of raw performance. So yes, that's what I tell our kids to do too. Split it that way. Now, I know some people want to add international funds, and we have talked about usually the large cap growth is hard in international because most of the large cap growth funds in the world are in fact U.S. companies. It's all these big tech companies, and they just don't exist too much outside the U.S. So there are explicit large cap growth funds that they're just not very good. I found this momentum fund, IDMO, which is a iShares fund, or is it Invesco? I can't remember which.
It's Invesco.
Invesco. That does fill that role pretty well. And then on the international small cap value side, AVDV is a choice there. If you go to Paul Merriman's site, you'll find other options for those, particularly on the international stuff. He's got a whole list of and a lot of these things did not exist 10 years ago either. So I think it's important to actually go there and take a look. Because I would not recommend you use a total international fund for this purpose because it ends up being kind of like a large cap value fund with a bunch of banks and stuff in it. And it just doesn't perform as well as your other options these days.
Okay.
I suppose you wanted to hear about other asset classes, huh?
Oh, please. Yeah. Actually, I was going to ask specifically about real estate. Does real estate fit into any of these portfolios?
Yeah, you can use it as one of the alternative assets. You can either put it there or you could include it with your stocks. And it's usually going to fall in the value category. You would need to take whatever fund you're thinking about and go over and put it in Morningstar and look at what it is. So yeah, REITs can fit into this somewhere if you'd like. If you're going to hold REITs, you want to hold those in your retirement accounts because they pay ordinary income. I would say the problem I've had with REITs in recent times is that if you go and look inside a fund like VNQ, it's mostly data centers and things like that, and cell towers. It's not traditional real estate. So if you really wanted traditional real estate, you may be better off picking up individual REITs, something like which is Realty Income Corporation and owns 9,000 leases on things like 7-Elevens and Walgreens. Or there are other funds like that. But every time I've looked at that category now because of the weird way the funds have evolved away from traditional real estate and into these specialty categories, because the biggest companies in REITs these days are Prologis and American Tower and all these things that you would not think of as being real estate. They're more tech related. So I would say yes, you can certainly add REITs into a portfolio like this. And in fact, I used to have a whole lot more REITs before I found I found the DBMF Managed Futures Fund, because I used to have about 10% in REITs in this portfolio, but I've migrated out of that because the managed futures tend to fill that slot better.
So we're coming close to the end. We got about 20 minutes left. So I want to keep moving on, if that's okay, unless there's some other.
No, did you want me to briefly go through the other asset classes with ETFs?
Yeah. Keep it brief,
Okay.
that'd be.
Yeah. So for treasury bonds, Vanguard has nice ones now. VGLT is a long-term treasury bond fund. VGIT is their intermediate treasury bond fund. If you wanted a short one, they have VGSH, and they have 16 other specialty bond funds that you could use. But you probably just want two of those or one of those. For gold, the cheapest funds now are IAUM and GLDM, and they have expense ratios of 0.09 and 0.1. For managed futures, the best fund now to use right now is DBMF, which has been around since about 2018 and is the closest thing to an index fund in that category. That is a category that is expanding. Both iShares and Fidelity have put out new managed futures funds in the past year. Problem is, I don't know how they're going to perform. So I would stick with DBMF in that category right now if you're going to use it. If you're going to use REITs, use REITs. Vanguard also has a utilities fund if you wanted to use that for something. I can't remember whether it's not VUSB. It's VU something.
Type it in exactly.
But if you type in Vanguard Utilities Fund, it'll come up. Yeah, so you could use that if you wanted to have an allocation to utilities.
So along the same line of implementation questions, so what accounts work best for this strategy? IRAs, 401ks, taxable accounts?
It's better if you have a variety of accounts, actually, because the assets naturally fit best in certain accounts. So the taxable accounts naturally want to have stocks in them, things that pay qualified dividends. That's like where you're going to put that. The IRAs, traditional IRAs, is where you're going to put bonds and managed futures because they both pay ordinary income. If you had any REITs, you'd put those in there. And this is basically what, if something pays ordinary income, it wants to be in a traditional IRA. A Roth can take anything of a growthy nature. So for a lot of people, that's where they decide to put their small cap value since they don't have any yet. So they'll just flip that from whatever it is into the small cap value category to so they don't have to have a tax problem or have a tax issue. And then gold can go anywhere. You put it where you have room. I would mostly put it in a retirement account if you have room in there for it. So that's basically where the locations are. But if you don't have room for something, you just you do the best you can. You put it where it goes. There's nothing particular about this portfolio that's so different from some other portfolio in terms of what account you want it in. One of the advantages of keeping, if you did have all this in a taxable account, I can tell you one of the advantages of having all these different assets in a taxable account is you'll get tax loss harvesting opportunities. It's very frequent that one of the assets in this portfolio is down in any given year, and so it allows you to do tax loss harvesting.
So I want to, since most of us are a little older, except for you guys. Um, if someone wants to start investing seriously at age 50, right? Some of our late starter audience that, catching up to 5 really targets, right? How should they approach risk parity then? You said it wasn't for accumulation, but how should they approach it then?
Well, I think Bill just gave you the answer, but I'll let him answer again.
Yeah, I mean, I'm kind of the dog and pony show there. I'm the guinea pig, which is fine. Educate. Accumulation is easy and easily DIY-able, as we've all learned and we're doing, and we're teaching our kids. I think the transition to enough psychologically, mathematically, and decumulation is much more complex. I think our 60s are much more complex with all the balls in the air for optimization that can drive you crazy. That's one of the reasons I wanted to go with an advisor. And Steve asked if I wanted to share that. I did share it on a podcast, but I'm happy to share his name. The thing about it is he does do projects.
Bill, I'm sorry to interrupt you. I think what they were asking is what kind of portfolio should you start with if you're starting accumulation at 50? And I think it's
accumulation at 50.
And I think it's the same portfolio you're talking about for your kids.
Yeah, it would be the same, but I probably wouldn't have 100% in equities. I'd probably be somewhere 80 to 90, and I would keep some version of bonds or cash, even though bonds seem to have some kind of a bad rep in our community. I don't know why.
Recency bias is what that's called.
I mean, now I was so happy to buy long-term treasuries. I can't tell you. It's the best time to buy them. Yeah, I'm actually thinking of adding leverage in long-term treasuries so I can open up more room in the equity side. So yeah, once you go down this rabbit hole, you end up sort of like, okay, maybe I can take a little more risk. Maybe I can gamble a little bit. Maybe I can leverage in my Roth so I can grow those faster. And that's why I have an advisor to keep me under control.
Probably a good thing.
So I mean, the short answer to the question is you can if you're at 50 and you wanted to start this knowing you were going to transition to a risk parity style portfolio, I would just start with the stock portion of it. So VUG and AVUV, you could start with that, because you're going to be able to accumulate in that just as well as any other 2 or 3 fund combo portfolio. And that way you don't have to transition it. Somebody just asked me this question. This is on my podcast today, believe it or not. A 48-year-old. But yeah, so you could use those 2 funds if you just wanted to do something simple. If you wanted to add the international ones, you could add IDMO and AVDV. But basically, I would, if you're pedal to the metal, that's 100% stocks is your best option for accumulation. And the only reason you wouldn't do that is you get queasy. But that's the best strategy, particularly when you're putting money in and you're accumulating. Particularly if you started at 0, you want the stock market to crash in the next couple of years because you're putting in more money later.
Yeah, I mean, what you don't realize is, as your human capital is a volatility dampener because you're adding to these portfolios. So you're reducing the volatility of your paper asset portfolios by earning and contributing. So it's actually less than you think. Yeah, I mean, it's really possible. You can do this in 10 or 15 years. We got to get that message out there. There are lots of great ways to do it. Some are better than others. And I believe that, what we've talked about today is a great way for a late starter that has 10, 15, or 20 years to do it in. There's no magic buttons, as Frank says, no crystal balls. You got to do the work, but you will get there. And, our community is proof of that.
Absolutely. So I want to open it up to questions here in the room and online. Did everybody get their questions answered?
I know there are a bunch of things in the chat, but I haven't been able to follow the chat. So if you...
Yeah, I'll get to those next. Yep.
Yeah, go ahead.
was gonna ask, what do you recommend as far as a resource for those that suffer from financial anxiety that have difficulty maybe the push to creating a portfolio and feeling close with spending?
Yeah, we didn't hear that. I'm sorry.
I said, what resources do you have recommend for those that have to deal with financial anxiety and struggle with transition to actually spending their money that you're talking about setting up?
Oh,
So, did you hear it or?
repeat it for me, please. I'm sorry.
So what resources are available for somebody that has financial anxiety? And I didn't catch the last.
And difficulty learning to spend.
Oh, and difficulty learning to spend.
I would say catching up to Phi. I would also say Frank's podcast, Risk Parity Radio. He's all about that. And it is hard. The Training Wheels portfolio is a great idea. I have one. I could show it to you. Going through a flat fee project to set up your transitional portfolio or map out your transition to risk parity is a good way to do it. It's a finite time period. You pay a flat fee. You work, say, with my advisor or other ones. There's a few others, but they're unicorns. I had to use AI to find them. And I'm going to share in the chat his name and his company name. He has, since I've been touting my transition, gotten inundated with calls. So you may have to wait a little bit. But are
you getting a commission from this now or something?
No, I'm just doing it. I'm just doing it for the benefit of the world. If he thrives, I thrive. That's the way I look at it.
Yeah.
But,
Okay. Yeah, this is really it's more of a philosophical question than anything else. I had one particular episode of my podcast where somebody asked me this very question. I'm afraid to spend money. What should I do? It's episode number 436. And in that episode, I also recommend in the show notes a series of books. Because what I think you really need to do is stop reading books about personal finance and start reading books about well-being later in life. So things like Bronnie Ware's 5 Regrets of the Dying, Richard Rohr's Falling Upward, the Arthur Brooks books about Strength to Strength, and his more recent one about living your best life. Because the issue becomes one of priority. And the statistic you really need to be thinking about is not what is your probability of running out of money in the next 30 years. The more important statistic is what is your probability of dying in the next 10. And if you are a 55-year-old man, it's over 10% already from all-cause mortality. And so I think I think the way to get over this is by changing what your priorities are and really sitting down and thinking, well, how do I want to live the rest of my life? And what do I want to do? And how do I want to contribute or not contribute? I think the book, Morgan Housel's The Art of Spending Money, read that. That's new. There's a chapter on the ways to have a bad retirement. One of them is being an accumulator with an accounting hobby, which is unfortunately what a lot of people in personal finance turn into as they age. The other book, The Soul of Wealth by Daniel Crosby. There's a chapter in that book that is entitled How to Spend Money to Buy Happiness. There's basically
we had Daniel Crosby on the podcast. There's a show we did with him. There's a show we did with Brad Klontz and Money Scripts.
Yep.
And it's all been about mindset for me in the transition. I call this what you're referring to as the fog of FI. And fog actually gets to stand for fear of getting out, or FOGO-FI. And that's where I'm at right now and what I just did, and I'm very proud of, is I cut 2 shifts off my schedule. I'm like, okay, I'm going to do this gradually. I'm not going to do this as a cliff. And I'm going to wind down the active income, wind up the passive income, put my toe in the water and not just jump into the deep end. And I think that's the genesis of the one more year syndrome, is the fact that the first thing I thought when I was told I was 5 was, I don't believe the math. And he had to tell it to me again. No, I don't believe the math. I'm going to have him run it again because I don't believe the math. And you have to sort of grow into the math with your emotions and realize that, yes, it's going to be okay. And you have to have your hand held. You shouldn't do this alone. Whether it's an advisor or a wise mentor, find your Yoda on this journey. And Frank has been a great one for me, as have a lot of you. Doing it alone is the fastest path to failure, I think. And it's really important. Get your philosophy on right. All the books he mentioned, I've read. They're fantastic. You can get addicted to reading the same way of doing things in 6 Ways from Sunday. But then when you're deciding how to live life first and not identify with money and accumulation and frugality and lack of spending, you're making a big shift. And it doesn't have to be all at once. That's, enjoy the journey through the fog of Phi is the way I would say it. And Jackie and I did an episode 196 on this, where I got to talk through it with your fellow group members. There are people that have been down the path ahead of you, and they can help you at least understand where you're at. Frank, do you have any other?
Yeah, I mean, this was actually part of the topic of my economy talk last year, about the Jordan Grummett's The Purpose Code does get at some of this too. That what you are trying to avoid is what is called the 4 idols. This comes from Arthur Brooks, and he got it from the Greeks, and it's been around forever. It's what Jordan Grummett refers to as big P purpose. And basically those 4 things are money, power, fame, and misuse of drugs and alcohol and things like that, or addictions. But the idol that mostly people are facing is the money idol. And what you need to replace that with, instead of going after these 4 idols, the power goes with your career. Fame now goes with getting clicks and giggles. The things that you can spend money on and your time on that actually will make you have a better life are relationships. They are things like activities that get you into flow states with people or with not people. They are buying your time back, paying other people to clean your house or take care of your yard or something like that. And then the 4th one is gifting. Red Hot Chili Pepper Fog, give it away. And that comes from Daniel Crosby's book, actually. Well, and he got it from other people. So there is this is not something to figure out. That's the biggest thing I could tell you. This is not something to figure out. It's something to learn. People have already figured this out. You just need to go read it. You just need to go learn it. And some of the stuff I've been talking about is what you need to go look at. The problem I see is people not wanting to learn. They go, I need to go over here and figure this out and keep looking at my numbers and stuff like that. That's not going to help. That's not going to really deal with your fears. You need to replace that fear with something more important to you. That what you should be afraid of is, I'm going to die and I'm not going to get to do the things I thought I wanted to do.
This is critical stuff. As late starters, I hid my head in the sand in shame from money. And then as catching up to fire who reached the pinnacle, you can kind of hide yourself in your spreadsheets in money. You need to pull your head out of your money ass, so to speak, and then focus on, more on the life aspect. And, I refer to this as kind of life as an open book test. It really is. And as Frank said, the information is all out there. It's been looked at before. And if you start with Bronnie Ware's 5 Regrets of the Dying, well, what are the 5 regrets of the dying? How do I avoid them? Okay, this is how I can strategize my life and reverse engineer it or invert it like Charlie Munger. And all I got to do is So at death, can I say that I don't have one of these 5 regrets of the dying? Great, I've won the game. And you're never going to be perfect, but if you look at those things, which are things like I work too much, and that's what I'm struggling with now too. How do I exit work gracefully? How do I let go of the addiction to saving, the addiction of work, and the values? And one of the ways it goes is a natural attrition, because I'm having all these things like this meeting today and what we're doing with Catching Up to Phi, or meetings or speaking engagements that are crowding out work, where I have to do less work in order to do more of the things I want to do. So it's kind of happening naturally. And then, the less work, relationships. I wasn't true to the person I wanted to be. I lived somebody else's life and not a life true to myself. What are the other 2, Frank? Do you remember?
No, I don't. Because I did do a Choose FI podcast about this book with Ginger Gray last fall. So, yeah.
And then Frank actually did me the kindness. He takes questions at his podcast, and you can ask him. You can send him emails, and your question will make its way onto Risk Parity Radio. And I sent in the question about the fog of Phi, and he ended up dedicating an episode, basically talking to me, which is talking to you and others about what is it like to go through this stage of the journey. And it was very touching. So you can listen to that if you want, just like Uncle Frank talking to you on your shoulder.
Yeah, I've got a lot more questions like that over the past couple of years.
Okay, so,
I'm like, this podcast is supposed to be about a bunch of numbers and portfolios, and now we're talking about.
Well, I mean,
that's the real purpose of all the numbers and formulas. You have to also recognize do have a list of things you want to do or get involved with, and start doing them. So Mary and I teach together. I sit on the board of a charity. I have the podcast. There's stuff that I've filled my life with that is way more fulfilling than working at a big law firm. And I think that's probably the other thing that you really need to focus on is so how am I going to live my best life, and instead of being afraid of living it, let's find some joy in here and go for a few things, because that's also going to be an experiment. That's one of the themes of Richard Rohr's Falling Upward book, that you basically have to go back to that beginner mind state where it's sort of like, well, I don't really know what I'm going to do. I know I have all this life experience now, and I can kind of figure things out, but you got to go test some things out in terms of doing some things, because once you find things that you enjoy doing with people that you enjoy being around, all of a sudden it's like, well, heck yeah, why would I not pull the plug now and go do this instead of
Jackie, my co-host, and I taught a class at the request of a professor at UT last week, and boy, that lit me up. And you guys have a superpower now of being financial experts, and look at what gift you can give. And that's what I want to do. I want to go from healthcare to wealth care, and physical and stuff, to more financial wellness and literacy. And there's such a need here. I mean, this can be a hobby for everybody in the room. And just what you've learned today, we've learned together. Just think about what benefit it has to somebody else in your life or the youth. And Frank likes to, it doesn't have to be anything grandiose. Just teaching that one class, I had goosebumps the rest of the day. And he talks about the story of the starfish thrower, and you may have heard this or not, but a kid's walking down the beach and there's a million starfish on the beach. It's kind of overwhelming, and he picks up one, throws it back in the water, and then an old man comes down the way and says, "What are you doing?" "Well, I'm helping these starfish." He says, "Well, that's pointless. There's no point to this. You're not going to make a difference." And the kid says, "I made a difference for that one." So that's the little p purpose that Jordan talks about. You don't have to solve the problems of the world, but if you help one person, oh my goodness, the power of Phi extends far beyond not having to go to work for a living.
Bill, I'm sorry, I got to interrupt you here a little bit. We're going to get kicked out of the room. The library's closing. So But thank
Bill and
you,
I
Jeff,
just
for what you
keep
do.
talking to nobody in particular. We're just
Let's see if we can talk about this for another 4 hours, right? But, we'll definitely try to have you guys back if we can, if you guys are open to that. And we truly appreciate all your time and wisdom that you imparted today. Thank you so much. And Sheila, did you get your question answered?
Oh, yeah, I did. I was just gonna ask a technical, I don't know if you guys can hear me. I was gonna ask a technical question on, you said to put, I think it was bonds in traditional, IRA, right, for the.
Talking to the speaker here, so we can.
This might be. Yeah, so you said, Frank, to put, into traditional, I think it was some bonds, but, I'm under 59 and a half, so I was wondering how that would work.
to.
For traditional 401k, you said like in terms of where to put your golden butterfly assets, you said to put stocks into,
Yeah.
the taxable. Right?
In your bond. Are you saying you have limited choices or?
No,
uh,
what my question is, I can't get it out because I'm only 48. So you said to withdraw money from one of your short-term treasury bonds, right? Use that as cash. So if it's
Yeah.
in your
You would do,
traditional, how do I get it out?
you do an asset swap. So you would sell the bond. You'd sell an equal amount of stocks outside, but then you'd buy the stocks back in the retirement account. So you would end up with the same amount of stocks. Some of them would be in the retirement account now, but you would have gotten the money out. That's a classic asset swap situation. So you're not actually withdrawing anything out of it, but you're just rearranging the assets a little bit, and then you rearrange the ones that are on the outside so you can actually get at the money.
So you're saying to temporarily you put the bonds into the taxable?
No, I'm saying temporarily put stocks in the bonds. So if you wanted to take out $10,000 out of this IRA, out of a short-term bond fund, you would sell the short-term bond. You sell $10,000 worth of short-term bonds in the IRA. You would buy $10,000 worth of VTI in the IRA. Then you'd go over to your taxable account and sell $10,000 worth of VTI in the taxable account. So you would end up with the same amount of stocks overall, but you'll have less bonds, but you wouldn't have taken anything out, actually physically removed it.
Okay, all right.
Yeah, it's the asset swap is what you're talking about.
Well, I want to thank Steve for organizing this and inviting us. These are exciting conversations, and I wish I had this conversation, years and years ago. But I encourage you to listen to his podcast. There's now 500 of them, and I'm still about 100 short of listening to all of them. But there's a lot. It's a relative library of wisdom, and his links are fantastic too. So yeah, you've got a lot of resources, and you guys are obviously cutting edge for having invited him and little old me to talk to you today.
Well, this has been great, guys. Thank you very much. Seriously, thank you so much for taking the time out of your Sunday to do this.
You're
Let's
welcome.
do it again.
You know where to find us.
All right, thank you, everybody.
Bye, guys.
Bye.
Where's the leave button?
Well, thank you.